Hey, my name's James Nicholson and welcome to my YouTube channel. Now in this video, we're going to talk about the Financial Times is reporting that house prices are down 13.5%, 0.4% even, from the peak already. Where have they got this data from? Who has created this? And what does this mean for homeowners and everyone interested in the property market? Now, before we jump into this video, as always, if you haven't done already, do subscribe to the channel over there and hit that bell notification. We're on the way to 10,000 subscribers now. We've got the last 1,000 subscribers in record time. So I don't know how quick we're going to get to 10,000, but each of you that subscribes makes it that little bit easier. And smash the like button, tickle the like button, do something to the like button over there, guys. That really helps us with the YouTube algorithm. We've had 200,000 views on the channel this month. We've hit the 1 million view mark as well. So that really helps us when you can do that. So, Savills, they're a big agent. Got lots of branches. They've got some sub-brands as well. And they've been doing an analysis of the nationwide data. So they've just looked at the nationwide data. And they're saying that house prices already are down 13.4% down in real terms. So we're going to explain what this means. In nominal terms, they are down 2.8%. So that's the headline that you'll get, 2.8% down at the moment. Now, this is interesting, and this is caused by inflation. And the reasoning for this is your house is worth less, even if it hadn't gone down. So let's just say your house was worth 100 grand and it dropped no money at all and it was still worth 100 grand. Well, actually, in real terms, over the last year, because of the super high inflation, your house is actually worth less. Because if you sold that house, what you could buy with that 100 grand today is around 10% less than it was a year ago. Because food, drink, petrol, oil, heating, all these things, apart from houses, have gone up in price. Even rent, the amount you could get rent somewhere, rents have risen significantly in the last year as well. So all of this is very, very interesting. And people call this type of property crash a silent property crash. So what's actually happening is affordability, it might not feel like it because the interest rates are higher at the moment, but affordability is improving. As inflation is being stubbornly high, the affordability of the property on the market is going to be better, as long as you are one of the people that get a pay rise that is above inflation. Now, on average, people are getting pay rises above inflation, but I do understand that some sectors are not. Finance sector is doing very well. Public is okay. Private sector is doing much better. But you might be an industry that's not doing particularly well. But on average, people's wages are going up faster than inflation now. So that means the affordability is improving. Now, why is this potentially really quite good news? Well, it's good because this means that less people could be in negative equity. And that's a positive thing. So really, if we're going to have a crash, I would rather a silent crash than a crash where we actually lose money. Because what happens is, if you've got a house and it's worth 100 grand, then it drops down to being worth 80 grand. And you had a 20% deposit on it at that stage. Now you've got a 0% deposit. So now when you go to refinance that property, they're going to expect you to top up the balance. Some lenders might be okay. The existing lender is your real shot. But if you go to a new lender, which is what most people normally do, you're now at 100% loan to value. That's not a great customer for anyone in this market, because if you lost your job or the market goes down even more, suddenly they get an asset that's only worth that money. Now, they would sell it in an auction or a distressed sale, and it isn't so good for these guys. And that's the problem that you've got here. And so silent property crashes are better because let's just say the inflation does stick around. That 100 grand house is still worth 100k, but if you bought something with that 100k, you'd be able to buy less chocolate bars, less Nando's, whatever you buy with your stuff, you will get less for your money. But when you go to refinance, you still would keep the same amount of equity in the property. So it gives you that option to actually refinance and hopefully be okay, as long as the interest rates add up accordingly. So this is kind of a good scenario. So there are lots of people out there saying the market's going to crash 20, 30%. Now, potentially that could happen. And if it crashes 20% in nominal terms, so 20%, so the 100 grand houses go down to 80, plus the inflation sticks around, well, actually, then the house prices might feel like that they've gone in real cash terms, what you can buy with your cash. It might be like a 30, 35% crash. Affordability would suddenly jump up significantly for a lot of people. So what we would really prefer, most people, and a lot of people that are sitting and they want to get onto the property market, their perception is they just want house prices to crash and suddenly be worth 50 grand so they can get on. But this is still good for them if the prices go down in a real world scenario, because inflation has eroded that property as well. That's positive for them just as much. And so this is actually probably the best case scenario. The fact that we've already had 13.4% in real world, real cash drops in property, then if we've got to get to 20, that might not be so bad. I would take all day long a 10% drop in the nominal price, as in the actual money that I'd have to pay to get it was only 100 grand house went down to 90, and then the rest of the price drop was done by inflation, and that wiped out another 10%, then I'd be happy with that. I think that would be a good scenario after all the high interest rates, the potential of a recession that the UK is going to go into, the jobs that are becoming less abundant as maybe they were a few years ago or months ago even. There are less vacancies in the UK now. So all of this stuff, I think, is positive. I think if the more we crash in real terms, better than crashing in actual money, the value, the cash sum that your property is worth being less. That's a more positive thing, in my opinion. So what do you think about this Saville report that the Financial Times are reporting on? It is factual. This is what's actually happening. So the market, the cash, like the price of your house has gone down 2.5%, but with inflation, it's actually down 13.4. I think that's pretty good news in all honesty. So let me know your thoughts on the comments. Do smash the like button, guys. Have you checked out some more content on my channel? We've got 560 videos on the channel now. So the next video you should be watching on YouTube is this one right here.